Welcome to the DeFi Standard, and this is Mickey B. Fresh.
And Patty XRP.
Today we got an exciting video. We have a new white paper out from Probity, which is a stable value liquidity protocol. So in the past, I've made some videos back in 2021 on Probity DAO being like a decentralized bank on the Flare network, and then Trustline being the network that will allow for multi-chain payments from XRP Ledger to Flare and Songbird. There have been some changes to the protocol Probity, and that's what we're going to dive in today. This new white paper, and we're going to go through some of the new stablecoins that have been added. So one of the key differences here, before Patty and I jump into this, is that Probity is now going to be an enterprise DeFi application. So retail, unless you're whitelisted and an accredited investor or an enterprise, corporation, institution, you're not going to be able to interact directly with the protocol the way you can with Flare Finance. There will be a Trustline non-custodial wallet that will allow you to hold and use all the stablecoins in a non-custodial way on the XRP Ledger, on Songbird, and on the Flare network. So that is still a great benefit here, because we know at the heart of all DeFi ecosystems is stablecoins, decentralized and centralized. So Probity added an array of stablecoins, and there's one interesting one in here that I think many people will gravitate towards and really like, and I do too, and so does Patty, is that it's an inflation-proof stablecoin using the value from 2020 prior to the pandemic. So this is something we're going to dive into. So Patty, what is Probity's stable value liquidity protocol?
Cool. So to start off here, we'll touch on the abstract and then get into some terms that'll be important, kind of describing key parts of this whole ecosystem that's going to be emerging. So with this, Probity is a software protocol for stable value liquidity. Probity LLC is a fund of funds that offers a revolving secured credit facility to commercial borrowers. The software implementing the protocol is owned and operated by Probity LLC. The protocol converts underlying assets into synthetic stablecoins and lends them to borrowers. Liquidity funds can be structured to accept investments in fiat, crypto, or both. Stablecoins issued by Probity LLC use a fixed exchange rate system that can be adjusted for inflation. Among the network's supported currencies is USD 2020, a stablecoin with a novel inflation protection feature. As the name implies, USD 2020 is indexed for inflation since the beginning of the year 2020. The tokens are fully backed by liquidity fund assets. USD 2020 token-denominated loans are adjusted for inflation upon origination, and persistent inflation is offset by interest rates. The minimum cost to borrow USD 2020 is enforced by the protocol and is set to the annual inflation rate of the dollar. And we'll touch on this one a little more as we get into this. So to bring up here, let's see, gotta get this. Of course, it's bringing up the wrong spreadsheet. All right, there we go. So kind of to break this stuff down. So Trustline is a financial technology firm. You guys are familiar with Matt Rosenton and his partner, which I believe it's Shine Lee, or I may not know how to pronounce it. So they have this corporation that they're using to kind of build out their products. Probity LLC is an enterprise DeFi borrowing, lending, and stablecoin protocol. So within Probity LLC, there will be different members of this kind of forming a DAO, and they will have caps on how much voting power individual members can, have within that. And these governors within the Probity DAO are going to be making kind of the decisions around parameter changes and protocol upgrades in the future.
Can we just touch on why they had to go this route to an enterprise DeFi borrowing and lending versus a direct, decentralized protocol?
Yeah, so I mean, the way this works is like a decentralized protocol, except for it's going to be permissioned on who can use it. So one of the things is being in the US, and also like Matt is doxxed. Everybody knows who he is. With launching this, he has gotten essentially counsel from lawyers, and I don't want to speak to that too much, that they would view this protocol as essentially security protocol with securities offerings and things like that. So they're going to continue to advocate for, better laws around people being able to use something like this, but they're going to wait until they can get actual clarity so that the entire, system, what they've built and what they can do, once this is launched, that's not harmed. They can at least get some of it out there to as many people as possible. But, hopefully in the future, we get more sensible laws in the US around who's able to use this kind of protocol.
Yeah, and I just want to reiterate there that this does not stop the protocol from launching. It will be enterprises, corporations, institutions, custodians, any entity, and accredited investors. So if you are an accredited investor and you're interested in this, reach out to Matt on Twitter or the Discord or Telegram groups that they have, and they'll be putting more information out. But also that even retail, we're going to be able to use all the stable coins. We're going to have a Trustline wallet here that's non-custodial that will allow you to do payments. Now, this is on the XRP ledger as well as Flare and Songbird. So this is not just a strictly Flare Songbird thing. This is a multi-chain. So that Trustline wallet is going to be non-custodial. You'll be able to hold all the different stable coins in there, and then you'll be able to utilize them freely once you have them. Now, this is just a little speculation before Patty dives into the stable coins. I want to throw out that it is possible in the future, now this is speculation, but I think it's well-grounded, that there'll be some type of intermediary or custodian that, like a Celsius or a Nexo or other type of entity, even an exchange, that allows you to actually lend and borrow just through them, and then they interact with the protocol and then give you the stable coin or pay you out the yield. So that's something we potentially can see. So that would be like a kind of a hybrid solution of what we're used to now. We're interacting directly. But with that could come insurance and additional security. So it's right now, unfortunately, Gary Gensler's there, and they don't have clear rules on this. So this is subject to change. Like this could open up to a point where we will be able to interact directly maybe in a year or two. So we just have to see if Congress puts through some legislation there.
Yeah, and I'll add, I totally understand, why their team's doing this. They need to protect themselves personally, and I'm sure, the last thing anybody wants is having the SEC breathe down their neck and them possibly, being on the hook for some kind of legal thing. So I totally understand what they're doing, and I'm glad that they're finding a way to at least get it out there in part. And like Mickey said, the beauty of it is we will be able to utilize the stable coins. There's nothing stopping the governance of Flare Finance from saying, hey, we're going to make a liquidity pool between ORE and maybe YUSD in the future. Or incorporating some of these stable coins or other projects that come out in the future could incorporate them as well. So with that, kind of touching, Mickey talks about the Trustline wallet is decentralized cryptocurrency and stablecoin wallet plus payments application. My understanding is they're going to be using the XRP ledger for the payment rails. Additionally, you may see this term Trustline Credit Network. So this is a regulatory compliant multi-chain stablecoin protocol built on distributed ledger technology. So, this will encompass at first Songbird, Flare, and the XRPL. Moving on down here, like we were talking about with USD 2020. So this is an inflation protected USD stablecoin from before the pandemic hit in March of 2020. And we know tons of money printed happened to kind of, try and stabilize the economy back then. So with this specific stablecoin is going to be fully backed by USD stablecoins issued from cash reserves. So this type of USD stablecoin that'd be used to collateralize the minting of USD 2020 would be something like USD coin, aka USDC, maybe like the Pax dollar, different regulated stablecoins that have a custodian that holds all the cash and cash equivalents for the reserves. One thing, this is a less decentralized stablecoin. However, they generally are better at keeping their peg. So that's one thing that people may prefer about this. And it's going to be adjusted using the CPI. So I believe in 2020, the CPI increased by 2 or 3%. And in 2021, it increased by over 7% year over year. So essentially, if you were holding this from, beginning of 2020 till now, it would have, held 10% value as opposed to maybe holding a stable coin that's going to lose purchasing power since it's directly pegged to the dollar. So that's something really cool. You can imagine, let's say it's 10% over a given year is what the CPI increases by. Holding this asset would effectively be the same thing as earning 10% interest on your, normal stable coin that you may deposit somewhere. Additionally, the inflation rate adjustments are configurable by the governance. So one of the things they address in the white paper is, there's no perfect way to measure what inflation is, so that those can be changed over time. Also, they'll look into using different signal providers to basically vote on a weighted average inflation. So it's not all just coming from one specific metric as well. So that's kind of using, the whole Oracle system. And then additionally here, so suppliers provide the USD stablecoin backing from authorized issuers, and then borrowers pay minimum interest rate of aggregate inflation from February 2020 or whenever they open up their position. So basically, to pay out the people that are backing this stablecoin, the minimum interest rate that anybody will pay at a given time is whatever the inflation is while they have essentially that loan open, plus whatever the interest rate would be for minting the Ore stablecoin and borrowing that. So it would be a higher interest, but that's because you're getting a higher, value, essentially stablecoin compared to your normal one. Now, moving on down here further, we have PHI. And PHI is going to operate similar to the Ore stablecoin, except for it'll be an experimental one on Songbird Network. So why is this one in general experimental? So it's going to have the USD peg like the Ore stablecoin, but it will have an inflation protection mechanism built in. And they're going to use Treasury inflation protected securities, provide the closest analog to inflation protection in traditional finance, which uses the CPI. So this will be like decentralized and backed by like crypto assets as collateral, like Ore would, but it will also have inflation protection features built into it, like USD 2020. So it's kind of a hybrid between the two. Now, additionally, this is going to be backed by over collateralized crypto assets, which could be, wrap Songbird, it could be native Songbird, it could be, FXRP minted on Songbird or like FBTC in the future. And that's one of the things in the future that the team is definitely going to advocate for being added as an F asset, from what they've written, is Bitcoin, because that could be really great collateral for this. Moving on down further. So Ore is kind of the one we know of the most as a community, I'd say, to this point. So this will be your normal kind of decentralized stable coin that's pegged to the US dollar, and it will be issued on the Flare network. With this, it'll be backed by over collateralized crypto assets like Wrap Spark, FXRP, it could be FAlgo, FDoge, or FBTC in the future whenever that's added as an F asset. The next one, which is technically hypothetical at this point in time, so it's, we'll have to see if they end up doing this or not, but it will be a regulated stablecoin with a similar backing to USDC. So it'd be something backed with cash and cash equivalents. This would also be able to be used to back possibly USD 2020 in the future. And the last thing I want to touch on as far as tokens, so I'll have the PBT token, which is going to be used for governance voting and interest accrual in some cases with the governors. So those are kind of a lot of the key terms there. I know we covered a lot. There's going to be several different stable coins. Some will be issued on Songbird, some issued on Flare. They'll all be able to be issued on the XRP ledger with something called the Solaris Bridge. In the future, they're going to have a specific white paper that covers that and how all that will work, but it will give the XRP ledger a decentralized stablecoin for, I assume the first time in its history, right, Mickey?
Yes, so there is no decentralized stablecoin on the XRP ledgers. The only decentralized asset is XRP. So that is one of the key components missing from the XRP ledger, because soon we'll have RA and fee. So you're going to have this stable coin that's going to be backed by Spark, Songbird, F assets, FXRP itself, trading against XRP. And another great thing here is all these stable coins are going to be able to easily move onto all the side chains. So we have three networks now. You have Songbird, you have Flare, and then you have the XRP ledger. So this is really intertwined into the ledger, is what Trustline's doing here. This is not just a Flare only thing or Songbird only. Yes, Probity is built on Songbird and Flare, but it's going to easily integrate with the XRP ledger. And the XRP ledger needs multiple types of stablecoins, everything from the decentralized ones like Fee and RA. Those are decentralized. They're backed by crypto collateral. The USD 2020 is backed by other centralized stablecoins like USDC and Paxos. So that's also needed. And just to touch on here, Ethereum's DeFi ecosystem, which is where DeFi was born, it at its foundation and at its core, it needed the DAI stablecoin from MakerDAO and USDC and Tether. You need the stablecoins at the heart of the protocol, at the DeFi ecosystem, to really expand outward and have this composable nature with other protocols. So getting stablecoins onto Flare, onto Songbird, onto the XRP ledger, I think is vitally important for a successful DeFi ecosystem and a tokenized ecosystem to develop in the future.
Yeah, and just think about with the Terra blockchain and their native asset Luna and using that to create UST or Terra USD. That whole ecosystem has really blown up and expanded tremendously around this one thing that they did, creating like a really solid decentralized stablecoin. So like there's another example of how important this is. With Polkadot, they have the Akala parachain, and they're looking to be like the DeFi hub for Polkadot. They're basically like focusing everything around the minting of their stablecoin and building out from there. So it is something like Mickey's saying that's extremely vital, and you'll see that across all these different ecosystems. I also think it's good to have, centrally issued stablecoins and decentralized stablecoins as well.
I think we have
I'd like to see they're doing multiple.
I think we have in the top 25, you have UST now, or at least the top 30. You have UST, which is the Luna one. You have DAI, and then you have USDC and Tether. So if you think about how many stablecoins are really exploding now because they're necessary, it's not just about the trading anymore. And that's what it was in 2017, 2018, 2019. But now these stablecoins are getting used in different DeFi protocols to tokenization and other use cases that are necessary. And it's not just the centralized ones. Yes, they are needed, but there is definitely a role, and we could see that it's another use case for XRP and Spark used as collateral. And that locks up more of the supply, and it is a use case. That is utility. And Ethereum's price has gone up as much as it did because there's so many billions of dollars in ETH locked in the DAI protocol from MakerDAO. So there's reasons, there's utility out there. So anyone who tells you that there's no utility taking place in crypto right now is obviously not looking at the whole industry and the ecosystem. There is a ton of utility taking place right now, and we're going to see that coming to Flare, Songbird, and XRP shortly.
Absolutely. So moving on to the next part of this, we want to do kind of a diagram of how Ore is going to be minted. And this kind of will work similar for Phi and for USD 2020. Certainly collateral ratios, interest rates, and things like that will be, different between all three, but this is the general mechanism for how they're all produced. So with that, we're going to have a supply side. Also, you'll see in the documentation, they call these liquidity providers. And then we're also going to have a borrow side where people can, take stable coins out and use them and pay interest for doing so. So with this, you will have different users who come in and they provide an asset backing. For Ore, that's going to be FXRP, FAlgo, FXLM, Wrap Spark. So those assets will come in. They'll be over collateralized, so over 100%. I don't know the exact numbers at this point, but they'll essentially back the minting of Ore. So once somebody comes in and supplies an asset backing, Ore can be minted, and that adds to the working capital of the system that can now be lent out. So what we'll have is borrowers who come in, they'll see, okay, this is an interest rate that I'd like to borrow at. They'll provide collateral as well. So we have kind of double collateral working here. The collateral is used for the actual borrowing, as opposed to on the supply side, it's used to actually mint the asset. So the system will lend out for you. You don't have to do any finding people to, borrow and stuff like that. It'll all be run by the system. So Ore will get lent out to these borrowers. The borrowers will pay interest back over time, and the Probity DAO LLC will take a small percentage cut of all the interest paying out, and the rest will be giving out to all the suppliers based on their equity share in the entire platform. So equity would be represented by how many Ore tokens that your position is currently backing. So like, let's say there's 1,000 Ore out there and you are backing 100 of them, you have a 10% equity share in the system. So with every interest payment that comes out, you'd get 10% essentially of that, minus the little haircut from the Probity DAO. Anything to add here, Mickey?
Yeah, so I just want to touch on how the system is a little different than Flare Finance, that there's two sources of collateral coming in, the borrowers and the suppliers. You could also call them liquidity providers, and this is based on an interest rate model. So this is how Flare Finance is set up. And this is probably more along the lines of what enterprises, institutions, and corporations are used to, because it has that interest rate set in regards to they know how much they're going to earn. It's not going to be a crazy high yield. It's going to be something that will be appeal to them. And this might appeal to the agents in the F asset system. These all overlap. So I think it's really good creating a foundation of enterprises, corporations, institutions to support this DAO, because most DAOs are supported right out the gate by a community. You got to get the community involvement, but they might not have all the intelligence to really govern that DAO the best, where corporation and enterprises might have a little better knowledge of spinning up a DAO. So this is a different model here, but the collateral backing is very different. You have two levels here. So I think it's a lower risk overall in the design. Now, it might not pay out as much interest, but I think a lot of people will say, hey, well, I can't access this directly right now, Patty. But that doesn't mean you won't be able to access it indirectly through some type of CeFi provider or some other application that taps into this. So one thing I know in our videos in the past we touched on was the ability to use our FXRP and Spark. Now, here's where the key difference and the really advantage of Flare comes in. Spark and FXRP are yield-bearing assets. They come natively with yield. So when you supply them as collateral, those assets are still earning yield. Spark will still earn the FTSO rewards while it's in there as collateral. FXRP will still earn the daily general rewards pool Spark assets daily. That's inbuilt yield. What are the best assets to use as collateral? Native yield-bearing ones. And this has shown to already take place in staking derivatives that are earning yield and used somewhere else. Now, these aren't staking derivatives. These are even better assets. So I look at Spark and F assets as premium assets because they come with this yield. Native Bitcoin, native XRP, they do not come with yield. So this is something that's going to appeal to any of these participants that are enterprise and corporations. When they're supplying Spark or F assets, they're earning in two ways, right? They're earning the interest here from supplying, and then they're also earning the inbuilt yields of that Spark, Songbird, or F asset. So I think that's very appealing. And in traditional finance, we don't have any assets that really are able to earn in two different ways at the same time, simultaneously.
Awesome. All right. Well, moving into the next part here, I do want to touch on just some examples of borrowing and what they'll call the investing side. So in these scenarios, we're going to say the price of FXRP is $1. So with that, if let's say as a supplier, you came in and you had a 1,000 Ore equity position, so that means you're backing 1,000 Ore that are minted. And we're going to assume that the penalty ratio kicks in at 150% or less. So this is like the minimum backing it needs to have at any given time. We'll say that this person puts in 2,000 FXRP to back this. So that's essentially $2,000 backing $1,000 worth of equity. So it's 200% is kind of the ratio there. What we can look at here, this person is able to do this. So since their equity times this penalty ratio is only 1,500, and this is less than or equal to the underlying backing times the price, which is 2,000, this person be able to open up a position. And they would be in good faith with the system as long as this underlying ratio here stays above the penalty ratio. If you fall below it, essentially you can get some of your collateral clipped and people will pay back some of the Ore that is now not sufficiently backed and deemed a little more risky. Now, the borrow side works extremely similar with the ratios and all that stuff. So if I borrow 1,000 ORE in debt at a liquidation ratio of 150%, but I put up 2,000 FXRP at $1, that's $2,000 backing 1,000 borrowed. So that means I have a 200% collateral ratio. Because the collateral value is higher than the debt times the liquidation ratio, that means I can borrow and I'd be in good faith. Now, moving on down here, I want to touch on how the algorithmic interest rate is set. So this is essentially a formula. It's going to be 0.01 over 1 minus the utilization ratio. The utilization ratio is a function of how much of the working capital which has been generated, so ORE minted, is currently being lent out. So if 5% of ORE stablecoins are lent out at a given period, that means the APR would be 1.05%. And you can see that it will exponentially scale as the utilization ratio increases. So, we kind of get up to, let's say, 50% use. It's only 2% APR. Still not terrible. However, once we start getting up to like 0.75 or 75% lent out, 80%, 90%, you can see this starts to exponentially increase. What this does is it encourages the borrowers to essentially pay back their positions before the interest rate gets too high and allows the system to recapitalize its working capital. The one reason you don't want the working capital to the utilization ratio to be too high is you still want to allow these suppliers to essentially redeem their collateral on demand. So like you aren't able to do that if there's not enough working capital in the system and it's all lent out. So that's why it scales in this way. So that's touching on that. And now get into a few more parts with this white paper. So let me scroll down here. Some of the like security measures. So risk management here. So the objectives are to minimize the value. So investor capital and margin, borrower collateral at risk at any given time. Both of these risks arise from the inherent market risk of asset prices. Times of market volatility are to be prioritized for active monitoring of system health metrics. In order to protect the creditors from borrower default risk, collateral may go up for auction to recoup the debts in periods of extreme market volatility. The fund's underlying assets may also be at risk of breaking the buck, a situation that occurs when the net asset value of the liquidity fund falls below $1. So to prevent this, essentially, one, they have removal of underlying assets and burning the mint in the treasury when the underlying value falls below the penalty threshold, while also assessing a penalty. So this is what we're talking about on the supply side, where you have to keep that minimum percentage backing at all times. If it falls below that, then you could have some removal of your collateral assets, as well as burning the mint in the treasury of the ORE stablecoins you've supplied, and you'd be essentially assessed a penalty fee. And then also another mechanism is increasing the interest rate algorithmically so as to incentivize fresh underlying assets and the repayment of debts. So when we're talking about that working capital utilization ratio increasing and that exponentially increasing the interest rate, what that does is make other people essentially start paying off debts, but it also encourages more people to be on the supply side and creating new backing because the interest rate is so high at that period of time. Now, moving on, there's additionally going to be borrower default risk. So credit risk is mitigated by requiring borrower collateral and over collateralize, on top of that. So when the collateral value falls below the liquidation threshold, the borrower's position is eligible for liquidation. Any user can liquidate an unhealthy debt position by calling the liquidate vault contract the liquidate vault method in the liquidator contract. So this would be something if you're able to interact with the system where you'd have a UI that kind of taps into that and you know what you're doing there. So essentially auctions follow the same format as MakerDAO. The winning bidder pays in the system stablecoin for collateral from the liquidated vault. The recovered stablecoins are used to cover the outstanding bad debt in the vault. The stablecoins go back into the treasury to increase working capital, and the system interest rate decreases to reflect the decrease in risk. So essentially what's going on here is, let's say somebody needs to be liquidated. They'll have an auction for people to buy that collateral. The winning bidder essentially will get a discounted price on the collateral they're buying, and they pay back Ore stable coins to do so, which eliminates that bad debt that borrower essentially could default on. Moving on down further, so there's something called capital inadequacy risk. So in order to prevent the net asset value from going below $1, investment positions are considered unhealthy when its value drops below the penalty threshold. So anyone can clip an investor's position to earn a part of the penalty fee. The position's assets are removed from the fund, less penalties, allowing the investor to reinvest at a higher collateral ratio. When the underlying assets are removed from the treasury, the interest rate increases to incentivize new investment and or debt repayment. And the reason it's, increasing is because you just got rid of those stable coins that person was backing, essentially. So it lowers that working capital and increases the utilization ratio. And then there's some fail-safe methodologies. So system insolvency risk. So this is like things are getting really bad for the system and it's having a hard time with those first steps and kind of recapitalizing everything. So system administrators can initiate a bond sale. This is a worthwhile option when market price volatility has dampened out and the shortfall is not too large. The bond issuer module allows new investors to purchase an IOU resembling a zero coupon bond. If you don't know what a zero coupon bond, it's one that doesn't pay interest, but trades at a heavy discount. And when it matures, you essentially get the full value of its worth. So in order to recapitalize the system, that's why they're issuing that. The bond matures when it is exchanged for reserve pool stablecoins. Since the bonds are purchased at a discount, the expectation is that a profit can be made if the purchaser has confidence in the system's ability to generate future revenue from fees. And the last thing is a shutdown sequence. And this is the last fail-safe where basically everything's shut down and they deliver out, borrowers get their collateral back, and suppliers get their asset backing back. So with this, the shutdown sequence mirrors that of MakerDAO protocol. The shutdown sequence gracefully settles the protocol while all users receive the net asset value of assets they are entitled to. And during this, underlying assets can be claimed by investors on demand. So that's kind of some of the safety mechanisms on the back end to help with the peg, to make sure that people aren't defaulting and all the stable coins are properly backed at all times.
Yeah, and then the last part here, oracles, is such a key, is a weak link in a lot of protocols in crypto and especially DeFi. And that's the one thing that Flare built into its core at layer 1. The Flare time series oracle solves this problem by constructing weighted average prices from multiple data sources. So with this ecosystem of, we're going to have up to 100 different signal providers providing price feeds. This allows for a robust ecosystem to provide the most accurate price feed. And here you want to talk about how Compound had a problem in the past with a single price feed.
Yeah, so essentially with this, and to kind of touch on this, a lot of, I'll say DeFi hacks in quotes because they're kind of business logic hacks. Essentially, like if you don't have a robust or decentralized enough oracle. So in this situation, it says basically, so Compound was relying on a single price feed for an asset pricing from Coinbase Pro. So they're pulling it from one area. We also know that assets trade on many different exchanges, many different decentralized exchanges, and we all know they kind of have slightly different prices at any given time. Sometimes when there's a lot of market volatility, this will get skewed way greater. So what happened here was that the price of an asset on Coinbase Pro, and this didn't follow the rest of the market, but it shot up by 30% due to a liquidity premium in 2020, and this caused close to $90 million of loans to be liquidated. So they were just relying on one single price feed. But if they were taking a weighted average from many different entities giving inputs and using the entire, landscape of trading for that asset, likely this would have been just a skewed number of the price. It would have been cut out and a more realistic weighted average price would have been delivered, not causing these liquidations to happen. So if you know that like a DeFi protocol is relying on one single price feed, if you're a hacker or an attacker, you can go and essentially shift that price, knowing which way it's going to go, and front run whatever actions going to be taken on the protocol level. And, this is something why oracles are extremely important. This is like one of the things I view about Flare, like what is going to make Flare valuable to the rest of blockchain in the future. And that's like this FTSO system and the state connector system and what those can kind of deliver together on a base level.
Yeah, because it's a weak link just pulling one price feed or just two. We see that there's glitches all the time in these APIs from exchanges, CoinMarketCap, CoinGecko. People think these prices are going, $1,000. It's just a glitch in the API. But if that happened in your application that you're using, that could be detrimental to all the users of it and the total value locked in there. So Flare and Songbird networks offer a decentralized Oracle layer built into the heart of the protocol. And that's something that all applications can be able to use on Songbird and Flare, but it also affects the XRP ledger too, because these stablecoins then are going to be issued on the XRP ledger. So it's basically utilizing that Oracle system for the stablecoins on Flare and Songbird, but then worry about building oracles on the ledger and all that. It's already there on Flare and Songbird. And that's why it's at the core. What they're building on the Flare network is the FTSO system was first, and then next is the state connector system. That's what allows these stablecoins to be able to then move over to the XRP ledger ultimately because of that. And that's what they're working on now. And it's connecting 5 different blockchains together. So this is not something that just happens overnight. It's a revolutionary technology, and it takes time to develop.
Awesome. Well, I'm really excited to see how this works in action. Certainly, I'm not an accredited investor, so I won't be interacting directly, but I could definitely see circumstances in the future where I want to hold USD 2020 or swap between ORE and something else. So at least some of the components or the outputs of this system will be available to everybody. And then hopefully in the future, we can get some better laws around allowing people that, just because they don't have enough money, like otherwise should be able to interact with. Any closing thoughts, Mickey? That's about it for me.
Yeah, no, I just think that we will be able to interact. I'm speculating here, but I'm pretty confident that there will be ways we'll be able to get access to the lending and borrowing through some other way. It just won't be maybe in a decentralized, non-custodial way. But one other thing I do want to bring up, we need to touch on, that Trustline wallet is going to be non-custodial and it's going to have no KYC. So you're going to be able to use that wallet, hold all the stable coins in there, hold any assets from Flare, Songbird, or the XRP ledger, and it will have the full capabilities of the XRP ledger's trust lines. And in the future, they'll be releasing a Solaris white paper, which will detail the bridge of how assets move from Songbird to Flare to the XRP ledger. And that should be coming in the coming months. But that Trustline wallet app, I know it's another wallet for everyone, but that will allow for the full capabilities of utilizing the XRP ledger and all these stable coins. And it will be non-custodial. So I repeat here, because I know there's going to be a lot of questions with this. Just because you can't use the protocol, you're going to have full use of those decentralized stablecoins. Now, those decentralized stablecoins, just like DAI and UST, there's no censoring on those. Once they're out there, they're out there. Yes, they can be tracked to what address they go to, but they are decentralized. So like Patty said earlier, Flare Finance wanted to create a liquidity pool, and the DAO governance there said, we're going to create a liquidity pool between, say, YUSD and RA, or Canary Dollar and Phi. That could be created, and there's nothing that needs to ask permission from Probity or any regulator. It just happens. And that's the beauty of open source, decentralized technology there. And I think that's going to be important in the future. And regarding yield, we could see those stablecoin to stablecoin liquidity pools. We know Curve DAO is one of the biggest DAOs, right? And that's a very low risk way to continue earning yield and set up these different revenue streams going into the future without having to worry about impermanent loss. You just supply 2 stablecoins. It's not everything is about a moonshot and the market's going to the moon. You have to set up different revenue streams, and these stablecoins allow for that. So it's more than just moon, cash out to fiat. We have all these new options coming. So now's the time to take the time to learn and understand how the technology works, because it's very important regarding your investment. This is not 2017. This is not 2018. This is a new market and a new industry, and it's evolving very fast. So we will keep everyone updated on this as we get more information. There is a beta. You do have to KYC if you want to participate in the beta. Otherwise, we'll wait for more details to come out. But this is exciting that it's going to be kind of an institutional enterprise grade DeFi application coming to Flare, Songbird, and the XRP ledger.
Yep. And one last thing I do want to add, because I feel like this could be a question as well. Anything that's issued on Songbird and Flare, as far as like ORE or PHI or USD 2020, you could also hold those stablecoins in Bifrost or Decent Wallet or MetaMask as well. So like you don't necessarily have to use the Trustline one, but it will, offer some payment features and utilizing the XRP ledger as well. So just want to throw that out there. But hopefully we did this justice, Mickey. This is the DeFi standard. I'm Patty XRP.
And I'm Mickey B. Fresh.
And we're out. See y'all.